Good evening, friends. On behalf of HDFC Mutual Fund, I wish you all a very COVID-free Diwali festival. As you know that IMF projections have been out and they are predicting that there will be some slowdown. But when we visit the streets of Mumbai, particularly when we see the traffic, or when we see Navratri Garvas happening in Baroda, or we see even Ganpati happened a couple of months ago in Mumbai, absolutely no signs of slowdown seems to be there. But anyway, we'll go by the what numbers are predicted or given by the. So therefore, the title India and Oasis in Desert. Why we are saying that? That when we saw 2008, couple of years ago, market reacted very harshly, adversely, correcting by nearly 60%. Rupee also depreciated by nearly 30%. But this time, when we are having a global uncertainty, markets are behaving altogether differently. And therefore, we have chosen this title on the eve of this Diwali and India and Oasis in the desert. Why is it so? So we have Chirag Setalvad, our head of equities, who will take us through what is our understanding of the current market, current economy, and what is the way forward that we think of that. But before that, we have a very special guest, Mr. Navneet Munot, our CEO MD, who will be giving his thoughts on this Diwali Eve for a few minutes, for a brief moments. And after that, we will hand it over to Chirag. And of course, with me is my colleague Ram Kumar, who will be moderating the call. So once again, wishing you all Diwali, happy Diwali, and over to you, Navneet.
Thank you, Ashok. And while we are here to hear from Chirag, to listen to his perspective on what's happening globally, what's happening in India's economy, and the outlook on markets and our funds that we have. But I thought that I will take this opportunity to thank each one of you for all your support. Your blessings, your good wishes, your support mean a lot to us. On behalf of each and everyone at HDFC AMC, I want to thank each one of you. This is a very cheerful Diwali. As Ashok just mentioned, we are all enjoying the social interaction. I think the last 2 years, we were bound by social distancing, but this time is different. I wish each and every one of you and your loved ones a safe Diwali, a happy Diwali, a cheerful Diwali, and a very prosperous and a blissful new year ahead. At HDFC AMC, we are driven by a mission to be the wealth creator for every Indian. And Chirag has titled it very appropriately, India is an oasis of hope. The world is dealing with several challenges, and I'm sure he's going to touch upon several of them. And in the interaction between Ram and him, we are going to discuss a variety of things. But India really remains an oasis of hope with democracy, demographics, demand, digitalization, and more importantly, the fifth D, the determination of over 1 billion Indians will ensure that over the next 25 years, as we enter Azadi Ka Amrit Kal, by 2047, as expected, we would be a $20 trillion economy. And at HDFC AMC, our mission, as I mentioned, is to ensure that as India grows from 3 trillion to 5, 7, 10, and 20 trillion over the next 25 years, together with each one of you, with support of each one of you, we reach out to as many households as possible and ensure that we also create a shared prosperity for each and every household. That's a message I wanted to give. Once again, a very happy Diwali and a prosperous and blissful new year ahead.
Thank you, Navneet, for your opening remark. And Chirag, all yours. So shall we begin with the presentation?
Sure. Just give me a moment to share the screen and then we'll start. So good evening, everybody. Thank you so much for taking the time this evening to hear our presentation. And before we start, let me echo what Navneet has said, and Ashok as well, and Ram, to wish you all an extremely happy and prosperous Diwali. As Navneet pointed out, after many years, after a couple of years, we now have the opportunity to be near and close to our dear ones. And I'm sure we are all excited to celebrate this Diwali with great gusto. So wishing everybody the best for Diwali and for the upcoming year. So what I have here is a brief presentation. We will speak for about half an hour, and we will cover two parts, the economy and the equity market outlook. But we're trying to keep the presentation a little bit short so that we have enough of time for Q&A. The market has been volatile, both in India as well as outside of India. And I'm sure there are a lot of questions, be it in terms of the Indian outlook or the global concerns as far as inflation and interest rates go, and of course, in terms of mid-caps, small caps, and sectors. So we'll try and touch upon this briefly, but leave enough of time at the end of the session for Q&A. So let me start. And I think we've chosen this topic very consciously because India does genuinely stand out as an oasis in the desert. What is the oasis and what is the desert? The desert today, when you look outside of India, growth is slowing down considerably. I think there will be few economies, if any, growing at the pace of India, and certainly no large economy which is growing at 6% which is what India is projected to grow at next year. In fact, the large global economies like the US, the UK, and the Eurozone are expected to degrow next year. So in that context, India's growth of 6% compared to the 1-2% degrowth that you're seeing internationally really makes India stand out. India is no longer a small economy or a small market. We are the 5th or 6th largest market in terms of overall capitalization, and hence India cannot be easily ignored. When you look at the concerns, so we spoke about growth, but when you look at the concerns which prevail internationally, they surround inflation, interest rates. And in India, the situation is considerably different for a couple of reasons. One is, India is accustomed to inflation of 5 to 7%. This is not an anomaly or an unusual situation. In the UK, inflation has just touched 10%. In the United States, is hovering around 8%. And these are numbers which these economies have not encountered for decades. Interest rates there have risen from close to 0 to 3, 4, 5, 6%. And these, once again, are interest rates which have not been encountered by developed markets for decades. India, on the other hand, has dealt with 6 to 7% inflation on a consistent basis. India has dealt with interest rates of 6 to 7% again on a consistent basis. So whichever way you look at it, from a growth perspective or from an inflation and risk perspective, India stands out. And it is because we are this oasis in the desert that the Indian market has performed as well as it has. And we will touch upon valuations going forward, but I think it's important to keep in mind that markets do well and badly always for a reason. And the reason India has done so well is because its growth stands out, because its inflation stands out, and even going forward, because the prospects on both these fronts stand out. So let me start with an overview on the economy, and I will spend just maybe 5 or 10 minutes on the economy and then move to the markets, because the interest tends to be more on equity markets than on the economy. But I think it is important to keep the economy in perspective, because at the end of the day, when the economy does well, companies do well. And when companies do well, the stock market will follow suit. And what we can see here is the last 40 years, India's growth has been quite consistent at 13 to 14%. Roughly half that comes from inflation and half of it comes from real GDP growth. But the interesting part is that we have had plenty of issues and plenty of risks and plenty of concerns and crises in the last 40 years, whether it was the Asian crisis or the dot-com crisis or the financial crisis. And despite all these crises, we have grown at a consistent pace. Today, we are in a different type of crisis, an inflation-driven crisis, in Europe, an energy crisis. But I think it is important to look beyond the current circumstances and realize that while growth may get impacted for a year or so, and more so outside of India than within India, when you look at it over a longer-term basis, growth in India especially has been extremely consistent. And it is important to keep this in mind, because when we as investors think of returns, our expectation typically is 13 to 15% kind of returns. And where do these return expectations get grounded. If the economy grows at 13-15%, it is fair to think over a period of time, companies will grow at a similar pace. And if companies grow at 13 to 15%, then over an extended period of time, even the stock market will give a similar kind of return. So let us briefly talk about some of the observations that we today see in the market. And we have highlighted, I think, the key issues and the key positives that we see in the economy today. And these are large positives. So let me start with the first one. We are seeing today a large shift from unorganized to organized players. In India, the unorganized sector is very large. It represents anywhere from 30 to 40 to 50 to 60% of various industries. And today, we are seeing a big shift in demand from these small mom and pop companies towards larger companies, which benefits the listed universe. And the reason for this shift is several-fold. It is partly the impact of demonetization, it's partly the impact of GST, and it is significantly the impact of COVID as well. Because post-COVID, we've seen shortage of labor, shortage of raw material, and this has exacerbated the impact of the first two events. And now we are seeing across industries a uniform trend where organized companies are gaining share. So this is one large trend that we are observing. And keep in mind, as I pointed out, this is 60-70% of various industries. The second is a China plus one story. Now, the China plus one story actually started gaining momentum under President Trump. When he started putting in place measures to protect the US economy against China, there was a thought that we need to diversify. At the same time, Chinese costs were rising. Chinese environmental compliance norms were becoming more strict. And because of all of these factors, people were already looking to diversify away from China. And India was a natural option because of its large economy, because of its cost advantages. And what really precipitated and gave this momentum a big push was the advent of COVID. Because what happened in COVID is, because companies were highly dependent on Chinese supplies and because of supply chain disruption, all of a sudden they were unable to source their material. And people realized, global corporations realized, that being overly dependent on one geography is fraught with risk. And they are now looking to diversify. Some of those investments will go into Indonesia, Vietnam, Thailand, but a lot of it will come into India because India is an extremely competitive and large economy. The third big trend that we are seeing is a sharp improvement in the Indian banking system. NPAs, which had peaked out in 2017-18 at close to 6%, are now fallen to 2%. Capital adequacy, which has been roughly 13 to 14%, is now at a 10-year high of 16 to 17%. And credit growth, which was languishing at 7-8%, has now improved to 15-16%, almost twice. And this is important because the banking system, the health of the banking system is key. It provides the liquidity for companies and individuals to spend and provides the liquidity for the economy to grow. So this is the third big trend. And the fourth, what we are seeing is the prospects for housing are looking far better. I have been traveling all over the country in the last few months, meeting investors. And the one observation that we have had across cities is that prices for many years have been flat. And in that period of time, salaries have gone up quite a bit, which means that affordability is at a multi-year high. But more than affordability is the advent of new regulation in the form of RERA. RERA now gives protection to investors who are buying homes under construction. Earlier, the developer was not held accountable, and now under RERA, if you don't deliver in time, you will face penalties, both civil as well as criminal. And hence, investors are much more comfortable knowing that they are protected under RERA to buy houses under construction. We are already seeing a sharp improvement in real estate volumes, and we think this is just the beginning and a trend which is likely to continue. And this is important because real estate is a large segment. When you buy a house, you need financing. When you buy a house, you need steel, you need cement. When you buy a house, you need consumer durables, you need fans, you need sofas, you need so many products. So the idea of pointing these 3-4 big positive trends is because they are very large. The housing segment is very large and important. The banking system is very large and important. Make in India, manufacturing, and China plus one is a big positive trend. And the shift from unorganized to organized companies is also a very significant trend considering the large presence of the unorganized sector. So again, India in that sense stands out. The Indian economy, the outlook is positive. We've seen a sharp recovery post-COVID. When you look at leading indicators of demand, things like GST collection are up 35% year on year. India's outlook from a growth perspective is promising. And India's situation is more benign than others as far as inflation goes. Hence, we are confident that India's prospects appear brighter than other global economies. And that is why we have termed this presentation as India an oasis of growth and an oasis managing inflation better in these difficult times. There are risks. So let us briefly talk about risks before we move to the equity markets. There are risks, of course, because of inflation, which is leading to higher interest rates, and global growth as a result is slowing down. At the same time, liquidity is also tightening up. But let us also try and look at what could possibly happen going forward. As growth slows down, we expect the pressure on inflation will ease. Why did inflation rise? Demand came back very quickly after COVID. That demand is now slowing down. There were a lot of supply constraints, port congestion, labor availability. That has now improved. Port congestion is no longer the concern it was during COVID. China's zero COVID policy meant that they were not supplying enough of material, and it was a start and stop as far as that economy went. Post the ongoing Chinese Congress meeting, we expect zero COVID policy will also get diluted. Lastly, Russia, Ukraine added to the inflation issues. But now things seem to have settled down, at least from a production standpoint, because pre-war, Russia used to supply 9 to 10 million barrels of oil, and it is back to 9 to 10 million barrels of oil. It is just the person who they sell to that has changed. Rather than selling to developed markets, they're now selling to emerging markets. So for a variety of reasons, we feel that commodity prices have a risk of coming down in the near term. And we've already seen a sharp correction in commodity prices, which we have shown in the table on the right-hand side. Energy prices have not corrected because of the impact of the Ukraine crisis, but outside of energy, already aluminum, steel, copper, agri-commodities have come down quite sharply. We think in the near term, demand will play a big impact, and hence commodity prices will remain under pressure. Longer term, it's not as clear, simply because there have been underinvestment in commodities, and that could, over a period of time, support commodity prices from a medium-term perspective. But the near term is still quite optimistic. So now moving to equity markets, we move away from the economy to equities, and how our valuations stacked up today is a key question. When you look at the Nifty, which represents large caps, the Nifty current PE is roughly 19 to 19.5 times 1 year forward. And that compares with the 10-year average of about 17, which means that the Nifty is a 10% premium. 10% for an investor who's investing for 5 to 10 years is not a very large premium. So for an investor who looks at a 5-year investment horizon, a 10% premium might mean a marginal contraction in returns, but returns should still be healthy from a medium to long-term perspective. These valuations, while they are a little bit expensive, it is because India is doing well that valuations are expensive. So our relative valuation to other markets may seem expensive. It is also because our fundamentals are far better than what you see outside of India. Moving away from Nifty, which represents large caps, let us have a look at how mid caps and small caps are valued today. The mid cap PE today is roughly 22 times versus an average of 18, which represents about a 15 to 18% premium. And when you look at small caps, that premium is about 10%. Small caps today trade, what you can see on the left-hand chart, which is the PE multiple, at a PE today of 16 times versus an average of 14. So when you put this together, what you see is large caps and small caps both trade at about a 10 to 12% premium, which is not terribly expensive, especially if you have a long-term rise. In the short term, you may see volatility because of what is happening outside of India. You may see volatility because of commodity prices, because of developments in Russia and Ukraine. But keep in mind the first slide that we showed, that how, despite crisis events, long-term growth in India has been very consistent. Keep in mind the big tailwinds that we have, which we spoke about in terms of housing, in terms of banking, in terms of formalization of the economy, in terms of Make in India and China Plus One. These are all big long-term positives. It's because of these positives that India relatively looks much better than other emerging markets and other developed markets as well. Let us briefly look at how sectors are positioned and valued today. And what we show you here on the right-hand side is a table at sectors compared to the historical 10-year long-term average valuations. And we see in this that there are several sectors today which still are reasonably priced, which include banks, both public sector and private sector, pharma, utilities, metals, and tobacco. There are others which are reasonably priced, higher than average, but not much higher, which are IT services and oil and gas. And there are, of course, a few segments which are expensive, which include things like consumer staples, and select parts of automobiles. When you look at this as a composition of the Nifty, which is what the pie chart shows you at the bottom, it gives you a fair representation that there is enough to pick and choose from when you look at the composition of Nifty. We are very stock specific in our approach. So it is not that we are suggesting any particular sector, but we focus on individual companies which are growing well at reasonable prices. We've spoken about sectors, so I will not touch upon it in great detail, but just to highlight that the outlook for financials is quite optimistic. Capital adequacy, as I pointed out, has improved. Credit growth is rising. IT growth is also positive. Concerns and margins are easing. Pharma is doing reasonably well from a domestic construct. The pricing in the US continues to be a challenge. When you look at global valuations have corrected. So this is slightly dated. And if you were to update these numbers for today's markets, you would see that US markets are trading at average, if not slightly below average valuations. And Europe has gone from trading at 20% below average to 25-30% below average. And I think this is good news because it is pricing in the risk of these markets. These markets or these economies are struggling, but the equity markets are already pricing that in. So let me summarize our views. India's outlook from a growth perspective appears stable, driven by a positive environment for infra and private capex, consumption expected to be stable, housing demand likely to improve. Balance sheets of banks as well as companies are strong. But yes, we have done well as a market. So we should be a little bit careful. Market returns are likely to be more in tune with growth, and there is unlikely to be a large re-rating. But growth itself in the Indian context at 13 to 15% seems sufficient. There are concerns in terms of rising rates and elevated commodity prices, but we think some of this will get mitigated over a period of time. These risks are now also getting adequately reflected in the valuation of global markets. India certainly appears relatively better positioned. It is an oasis in the desert. In summation, we'd also like to point out the importance always of asset allocation. And investors must carefully look at portfolios to see how much they have in equities and debt, because that will drive overall returns. Always invest for the long term to harness the power of compounding. SIP investing works well, and we've seen how SIPs have ballooned in this market. It helps because you get to capture both down markets as well as up markets.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.